Welcome to the Financial Integrity Hub's podcast. The Financial Integrity Hub pioneers research and explores how law and governance strategies can be designed, implemented and enforced to support anti-money laundering and counter-terrorist financing. This podcast is proudly sponsored by Identity, a RegTech providing financial institutions assurance that they are meeting AUSTRAC reporting obligations. The platform allows regulated entities to gain visibility over transactions, improve auditability, automate manual processes, and reduce the risk of non-compliance. Your host is Isabel Nicholas. Isabel is a researcher at the Financial Integrity Hub. She teaches financial crime at Macquarie Law School and interviews global and domestic experts on trends and market insights for the podcast.
Welcome back to the Financial Integrity Hub's podcast, where we unravel the critical vulnerabilities faced by gatekeeper professionals in the realm of financial crime. In this eye-opening episode, we sit down with Neil Jeans, an expert in financial crime prevention, to discuss the benefit of regulatory oversight on lawyers, accountants, and real estate agents. As Australia prepares for the much-anticipated Tranche 2, extending AML regulations to these key gatekeeper professionals, the industry and its critics are gearing up to voice their concerns. But what are the real risks if we choose not to regulate these essential players? Are the concerns genuine or merely hypothetical? Drawing from compelling cases from around the world, Neil shares the benefits that arise from regulating gatekeeper professionals. With insights gained from his experience in implementing regulations for gatekeepers in New Zealand, Neil highlights crucial lessons that Australia can consider to ensure the seamless integration of Tranche 2. Thanks to our listeners for tuning in. You can find this and our previous episodes by searching the Financial Integrity Hub at Macquarie Law School on LinkedIn or on Macquarie University's website. Neil Jeans has a unique background in financial crime risk management, spanning almost 30 years, including working at senior levels managing AML CTF, sanctions, and anti-bribery compliance across Europe, the US, Latin America, Asia, and Australia, within two major global investment banks, one European financial services company, and a major Australian bank. Neil has been providing specialist AML CTF consultancy services since 2012, including giving advice and support to businesses subject to AML CTF regulation, developing and delivering money laundering and terrorist financing risk assessments and AML CTF programs, undertaking independent reviews of the adequacy of AML CTF compliance, and providing advisory services in relation to regulatory compliance and regulatory enforcement activity. Neil has supported businesses in responding to formal AUSTRAC investigations, has acted as an AUSTRAC authorised external auditor, has acted as an expert witness in AML CTF enforcement actions, and has undertaken reviews to confirm the completion of AML CTF remediation activity. Neil, thank you so much for joining us today.
Thank you. Lovely to be here.
Let's get right into it. For over 17 years, it's been recognised internationally that DNFBP sectors, so that's largely our lawyers, accountants, real estate agents, because of their gatekeeper role, have been vulnerable to abuse by criminals and attractive to those wishing to launder the proceeds of criminal activity. Can you provide an overview of the Tranche 2 reforms that were implemented in New Zealand to regulate these gatekeeper professionals?
Absolutely. And I think sort of not to give everybody a history lesson, but I think it's been internationally recognised for many, many years, going back to the 1990s, that professional money launderers really seek out the use of this type of gatekeeper as you described them. It was really only in 2003 when the FATF formalised those concerns in the requirements for designated non-financial businesses, and obviously brought with intention that all countries covered by the FATF should bring those into the regime. New Zealand did this obviously back in 2017-18. That was really predicated by the Panama Papers, because effectively the Panama Papers shone quite a bright light onto the corporate trust environment within New Zealand and some of the vulnerabilities that resulted from there. The New Zealand government acted relatively quickly and effectively introduced the Tranche 2 or Phase 2 requirements, as they call them over there. What they effectively achieved was to bring all these professionals, so lawyers, accountants, and real estate agents and professionals, into the AML regime. The AML regime in every country is really around engaging the private sector in playing a role to prevent and detect and deter and ultimately report money laundering and terrorist financing. So bringing these type of organizations into the regime ultimately resulted in them being required to comply with the full gambit of AML/CTF obligations that were currently in New Zealand at that time and really only focused on financial institutions. And effectively, that was a rolled out approach where basically over the course of a year, each industry was basically brought in to those regimes. Those requirements extend from knowing your customer all the way through to reporting particular transactions and also reporting suspicious transactions, as SMRs are known in New Zealand.
And it was lawyers that were regulated first, wasn't it?
It was lawyers were brought in first, and then it was accountants, and then last but not least, it was real estate agents. And I think the way that New Zealand brought them in was really to identify certain activities that they believed were vulnerable to money laundering. So it was the essence of a risk-based approach, which was to say, what services do we believe create a significant risk to being abused by money launderers? And we're not casting dispersions on lawyers, accountants, real estate agents, that they're criminals and that they're up to no good. The vast majority of them are very legitimate, very hardworking and diligent businesses, but some of the services they provide have been recognized to be very attractive to legitimate customers, but also to potential criminals who want to use those services to meet their money laundering and other criminal activity ends. So that was the thought process about bringing people into the regime, was bring them into the whole regime. It will be targeted very much on a risk basis to the types of activities. So just because you're a lawyer doesn't mean you're caught. Just because you're an accountant, it doesn't mean you're caught. Just because you're involved in real estate doesn't mean you're caught. It's really based on the types of services that they're undertaking. Obviously not a dissimilar approach to the designated service regime that we have in Australia, which is probably the most likely way that our gatekeepers will be brought into the AML regime through the identification of additional designated services.
Absolutely. And I guess on that note, do we have real evidence that in practice, these professionals, lawyers, accountants, or real estate agents are actually being used by criminals for money laundering? Or is this, a hypothetical assertion based on the types of services and the risk that is associated with those services?
From my perspective, being a former police officer investigating money laundering and international money laundering, there is direct evidence that the criminals use these services, these gatekeepers, to basically achieve their ends. If you think about the modus operandi of a money launderer or criminal, one of the things they crave is anonymity. Another thing they crave is obviously breaking the audit trail, so therefore you can't follow the money and link it to the crime. And those are obviously the two things that, as a money laundering investigator, you have to prove: whose money it is and the money came from the crime. And some of the services that are provided by lawyers, accountants, and to a certain degree real estate agents ultimately support that end. And that's really the essence of why the AML regime sort of exists. I'm old enough to be there when it was first envisaged in the early 1990s. I was working in financial crime at that point in law enforcement. And we realized that there's a lot of intelligence and a lot of information out there in the public sector or in the private sector that ultimately would help us catch bad guys. And actually, it's the use of those type of services, and obviously quite legitimately we focused on banks and financial institutions fast because that's where the money flows through. But it became increasingly apparent that gatekeepers of this type were heavily involved, whether they are helping knowingly or unwittingly. Vast majority, I would suggest, unwittingly to use these services for criminal activity. Direct example of that is one of the cases I worked on was related to a gentleman called Stephen Sakosha, who's currently in a federal penitentiary in the US for laundering the Cali cartel and Medellin cartel money. He's currently doing 660 years in that federal penitentiary.
Oh, wow.
He used gatekeepers. Part of the laundering systems that he set up for those crime organizations in Colombia was the use of gatekeepers, the use of companies, the use of lawyers' accounts, primarily to help launder. And it's fair to say most good laundering systems, if you can use that term, that at least have one accountant and one lawyer involved in them because of the protection and the legitimacy that offers the activity. On the flip end, the end of the launder for Mr. Sakosha and his associates was buying real estate, buying property, because effectively it's a valuable asset. It's a good store of value. It's also an asset that generates income. So this really the end of the launder. It's the integration stage of the launder, which is that flight to legitimacy that obviously buying property allows you to achieve. So each of the different gatekeepers play different roles. They offer different levels of attractiveness or different types of attractiveness to the criminal, but it's appropriate they're all brought into the regime for those different reasons.
Thanks, Nelly. That's really interesting. Can you highlight any notable outcomes or maybe achievements resulting from the implementation of Tranche 2 reforms in New Zealand or even other jurisdictions, and how it's impacted the financial industry and the overall effectiveness of AML efforts?
Absolutely. Again, I think it's recognized that not having the professionals in the regime is a gap because of the way that these parties get involved in the financial side of the world. So you think about opening bank accounts, formation of companies, all those type of things. So they're a fundamental principle of the financial services industry, and I think that's been recognized for a long time. But I think the real tangible outcome is what I would call the intelligence dividend. As I said previously, reporting entities are called reporting entities for a reason. Their key job is to report, obviously report accurate and correct information, hence why there's things like customer due diligence and other elements. But ultimately, it is the act of reporting. So from a New Zealand perspective, we've seen the PTR regime, the transactions, the cash transactions and the international transactions, the level of reporting of those go up significantly. That means that the law enforcement authorities in New Zealand have far better intelligence to help them investigate people that they suspect of money laundering or criminal activity. The same with SMRs. Again, there's increased level of SMRs in New Zealand coming from lawyers, accountants and real estate agents. That's giving law enforcement new insights into sort of criminal activity or potential suspicious activity that's occurring in New Zealand. So that's the net tangible benefit of bringing these entities into the regime, is ultimately to increase the intelligence dividend available to law enforcement. And really what the regime is doing is getting or requiring those type of businesses, as it is for financial institutions, to play a particular role in terms of knowing who their clients are. That reduces anonymity, keeping an eye on what the customer is doing to identify if there's anything suspicious, ultimately reporting them, but also then the additional PTR reporting, which we would know in Australia as TTR and IFTI reporting, is called PTR reporting in New Zealand. The level of intelligence and information that is being gathered there will pay dividends for years to come and will continue to pay dividends for years to come, because effectively they are incredibly valuable reports that allow investigators to identify and map where customers or people or targets they're focusing on have their money or are undertaking transactions.
Absolutely. What role did collaboration and coordination between different stakeholders, such as, government agencies, industry associations, and gatekeeper professionals themselves play in the successful implementation of the Tranche reforms in New Zealand?
Well, you've hit one of my orange box moments, because there was good coordination. And I think that's something that we can learn in Australia about coordination between the regulator, the regulated, and other stakeholders. And one of the things that they did relatively well, although I think everybody in New Zealand agrees it could be improved upon, and that's something we need to take forward into Australia, is the level of guidance and the level of support that you are providing to the businesses that are being brought into the regime. If you think about it, most of the gatekeepers will be doing some type of activity which can be repurposed for anti-money laundering purposes. But there's a lot they need to learn. There's a lot they need to be educated upon. And one of the key collaboration and coordinations is really understanding or providing the guidance. So, for example, the DIA, the regulator in New Zealand, did roadshows around New Zealand to educate lawyers, accountants, and real estate agents about what was required. They worked closely with the trade associations and other interested stakeholders to make sure that information really hit the mark and address some of the issues and concerns those stakeholders had, and also obviously the industries that were being brought into the regime. There was also a significant level of collaboration around shaping the requirements, making sure that they were right-sized. And I think that will be equally important from an Australian perspective. If we are fully intending to bring these people into the risk-based approach, we really need to understand what the risks of these businesses are, and then make sure the designated services that are shaped in the appropriate way, and particularly, more importantly, the definition of which customers are receiving those designated services is equally important. And to give you an example of something that caused problem for New Zealand, under New Zealand law, every trust is considered high risk. It's mandatory, it needs to be subject to enhanced customer due diligence. So if you have bought your house 35 years ago, you converted it into your family trust after you paid the mortgage off for inheritance reasons, etc., and you then suddenly decide you want to sell that house, that sale of that house is now subject to enhanced customer due diligence and, strangely enough, source of funds and source of wealth. So you've actually got to prove how you got the money to pay for that house 35 years ago. An unintended consequence of the legislation, which is now being worked through in the reforms. So there needs to be collaboration, there needs to be engagement, there needs to be a significant level of working together. We had that in Tranche 1, as I call it, the first round in 2006-07. Where the industries that were impacted there worked very closely with AUSTRAC and the government of the day to make sure the legislation came in and it was the right type of legislation. I think the challenge you've got in Australia is simply scale. If you think about the number of reporting entities, the disparate types of reporting entities, that's going to be an increasing challenge for bringing this regime and making sure this regime is right size, let alone rolling out guidance to every major town in every state in the whole of Australia. That's a big piece of work for somebody. Somebody's going to get a lot of air miles, I would suggest, doing that type of stuff from Austrac. But ultimately, it needs to be done to raise awareness and get people the right tools they need to collect. Because my experience is most people, they don't do this willingly. This is not something they woke up in the morning and go, right, I'd love to be regulated by AMLs, the AML regime. But it's something that they will try to do as best as they possibly can. But we need to provide the tools to them to allow them to do that, basically. So, that coordination, that collaboration, that clarity of purpose, that clarity of support and depth and breadth of support is going to be vital to make sure that this regime in Australia gets implemented effectively. And bear in mind, the end of this process is the FATF mutual evaluation in 2026, which is an effective in practice assessment, not a design assessment. So effectively, we are going to need to demonstrate that this regime has been implemented and is effective and is delivering the outcomes that we expect it to do. That's a lot of work, a lot of effort to get done in a very short period of time.
Absolutely agree. And, that education piece is going to be so important from Austrac and for all the newly regulated entities. So do you think that with the expansion of regulated entities in Australia, that's likely to increase by tenfold to over 100,000 entities? So how do you think that Austrac will manage and resource itself with all these new entities?
That's, again, an interesting point. I don't think there are enough regulators in Australia or enough people that want to be regulators in Australia to cover this. I think, as everybody recognises, Austrac has a problem of attracting and retaining staff simply because people are being paid a lot more money in the reporting entities to do the same type of work. So my view is that Austrac have to think outside the box. I think there are technological approaches that can achieve this. We've already seen that to a certain degree with the beefing up of the annual compliance report, where it's a significant report that are significant detailed questions, which is required to be submitted by every reporting entity every Q1 of every year. Austrac 4 or 5 years ago invested a significant amount of money in the analytical tools they have at the background of that, and that undoubtedly will be a significant supervision tool that they will use. But I think they've also got to look at other supervision methods that will need to be applied. And to a certain degree, that won't be people visiting every law firm or accountancy business or real estate agent anytime soon. It will be intelligence-led. It will be risk-based led. They will rely significantly on the major bodies within each of those different industry categories, as they have done with the financial services sector. So you've got the big four banks, they focus on those. You're probably going to have a significant focus on the big 4 or 5 real estate agencies, the big 4 law firms or big 5 law firms. The smaller ones will get picked up. They're potentially less of a risk at this point in time, unless you get intelligence-led indications that they're not doing the right thing. I think also one of the things that they will also think about is, to a certain degree, outsourcing some of this supervision, which may well be things like mandating the frequency of independent reviews and potentially the ability to submit those to Austrac for review, because effectively that's a good way for them to supervise entities. We're also seeing in the Part 1 consultation an increase in the standards they're applying for the compliance officer. So the compliance officer within these organisations will have to meet certain fitness and proprietary standards. So therefore, you can see that they're almost outsourcing some of this supervision, or they're creating an environment which is sort of allows them to be the supervisor, but effectively allow information to come to them rather than having to go out and find it, which is a bit of a departure for Australia, but pretty similar to the way things work in both the US and the UK, where obviously there are obligations on the compliance officer who is effectively deputised by the regulator to do certain things within the organisation. I think we may see that coming. But again, along with that requires training, awareness and knowledge of those people. They can discharge their duties and responsibilities. But having an effective regulator is going to be important. And I think there's going to be a lot of work in that space. So I can't see Austrac's numbers growing tenfold. Obviously, we've seen them give a little bit of budget or be given a little bit of budget in the last budget for the exploration, but it's not a lot. I would expect maybe in October, but possibly in the next budget in May next year, there will be a significant uplift in their budget to really just cope with these reporting entities. We have the supervision levy as well, whether they're going to apply the supervision levy to this cohort of reporting entities, which means they'll get funding from that, which may help them fund the supervision activity and the enforcement activity that they may have to undertake.
If we look ahead at the experience and development of New Zealand's Tranche 2 reforms or other jurisdictions, how are the areas of improvement there that are necessary, and how can Australia leverage that knowledge to enhance its own upcoming implementation process?
Well, I think we've got better at it internationally. When most organisations introduced these legislation, they had not done a national risk assessment or understood the risks in each of these. In recent times, in 2019, post-implementation, we saw a national risk assessment from New Zealand, which talks about the sector to a certain degree. But certainly, from my perspective, the most informative national risk assessments are the UK and the Canadian one, UK done in 2020, and the Canadian one done in just recently in 2023. Those national risk assessments talk about the vulnerabilities of these sectors. And I think the key lesson learned is that the regime needs to be aligned to those vulnerabilities. And those vulnerabilities, as I said previously, are really around what types of services are attractive to the criminal. So if you look at the consultation, there's this throwaway line in there relating to leasing in the real estate sector, that leasing is high risk. But I think we really need to explore what type of leasing is high risk. Is that leasing of a shop to a business, or is that leasing of a residential property to somebody? What is the type of leasing that we are concerned about, or what the AFP are concerned about? And again, we see in the UK, they've adjusted their regime, so therefore they've set de minimis thresholds that says, if the rental is less than 10,000 euros a month, it's outside the regime. So they're focused on the risk, they're focused on the really important elements of it. Is there an opportunity to do that in Australia? I think there is, as an example. I think there's also an opportunity to look at the extent of the lease. So is a 3-month lease really something we're concerned about, or is it a longer lease that we're concerned about? And this is based on the understanding that the whole risk around leases is that the asset has been bought with criminal money, and effectively the criminal is now generating legitimate income from that illicit asset base. With that level of understanding, you can start to shape and mold the regime into something that really works and is really targeted. And that also follows on to who is the customer. So is the risk the customer, or who is the customer that potentially creates the risk? New Zealand had an attempt at that in the real estate sector, where they made the real estate sector focused on the vendor, the seller of the property, not the purchaser. They left the purchaser to the conveyancer. Whether that will work here, they did get slightly criticised by the FATF mutual valuation a couple of years ago that wasn't necessarily 100% correct, because it's about buying and selling. But I think these are the conversations that we're going to need to have in the next 6 months to a year to really make sure the regime is appropriate. If you go into the legal side of things, who is my customer? Is it the person that I'm setting up the company for? Is it the person that I'm managing their assets for? Who is that person, and how do I identify them? And therefore that starts to limit the scope and extent of the regime, but makes it hopefully an efficient and effective regime, because it's based purely on risk, but it's actually actual risk, not theoretical risk. So I think we can learn a lot from overseas in that area. I do note with interest that certainly my engagement with the Attorney General's Department during this process, they have signalled that we will get a national risk assessment for Australia by Christmas this year. It'll be an interesting Christmas present, but I think it'll be a Christmas present a lot of professionals in the AML world will be grateful for, because it will give us a basis to start to work out these things on. I'm eagerly awaiting that Christmas present from the Attorney General's Department on Australia, and I'm sure hopefully a lot of AML professionals will be the same, because it should be fascinating.
Absolutely. Thank you so much, Neil, for joining us today on the Financial Integrity Hub's podcast. It's been an absolute pleasure.
Thank you for inviting me in. I really enjoyed the conversation, so thank you.
The Financial Integrity Hub's research equips Australia and the international community with the knowledge, tools and insights to understand, identify and disrupt illicit finance threats. If you're interested in seeing more from the Financial Integrity Hub, don't forget to follow us on LinkedIn to see our posts and events. We post a few times each week on breaking news and the latest research. We would like to thank Dr. Doran Goldbarsch for his academic advice and Isabel Nicholas for hosting.